Would you not want to know early warning signals that tell you something about the long-term sustainability of the hotel itself? As in, whether the hotel will survive over the longer term. Am I being dramatic? Not really. Profitability ratios are those early warning signals. But what are these profitability ratios? Let's get to the most important profitability ratio for your owners, and you would want to know about that, right? Net income. Net income is a profitability ratio that uses two other key performance indicators or KPIs of a hotel: earnings and total revenue. Let's take a quick look at both these items. Now, why should you want to know about net income? Because it's a favorite ratio with your hotel owners and is now being pointed out the two elements that make up that net income: total revenue and earnings. Earnings, of course, are also called net income, sometimes net profit. Total revenue in this instance is for the entire hotel, and earnings is also simply total revenue less all expenses. We shall take a look at these more in detail as we go along. As I said, net income is a profitability ratio, and it measures the profitability of a hotel after deducting all operating and non-operating expenses. Note 3 points about the net income. It's after deducting all, that means every kind of expenses included, every kind of operating expenses included, and every kind of non-operating expense. But you would want to know, what is profitability in the first place? Well, loosely you could say it's the long-term ability of your hotel to be profitable. And profitability obviously has connotations on the ability of the business to survive over the long term. But ability of the hotel to survive and earn profit has two elements to it: revenue and expenses. And hotel needs revenue to continue or stay in business, and they need to incur expenses to earn that revenue. But expenses create risk in business. So at the end of the day, you could say revenue minus expenses results in profit. Let's summarize this profitability and net income element. Profit is arrived at after deducting expenses from revenue. So expenses reduce profit. Reduced profit is thereby a risk. That risk is related to this profitability. And we noted that profitability is also called earnings. It's also called net income in this case. But the hotel is a seasonal industry with earnings going up and down. Those up and down fluctuations are the ones that cause the risk. Let's understand this total revenue and earnings in greater detail. So net income is what we are going to be looking at. So your first question would be, as you can see, net income is being pointed out. Your first question would be, what is the formula for calculating net income? Well, it's simple. We will be using the 2019 Paradise Hotel current month number to calculate the ratio. Number one is net income, of course, and is being pointed out right now as 1. And number 2, of course, total revenue. And then we multiply that by 100. Let's apply some numbers to this. Net income is 411,773 and is being pointed out now, divided by 1,645,814 total revenue and is being pointed out. When you multiply that by 100, you get 25.0%. So what does a net income of 25.0% mean? Well, it means that the hotel has earned 25 cents as net profit out of every dollar of total revenue. You could also say that the hotel is earning 25% of every dollar of total revenue. In a way, the net income shows how well the hotel has managed all expenses, which translate revenue to profitability. Now you would have a question. Is there any industry norm for net income as to where net income should be or what percentage it should be? Well, not really, because net income depends upon multiple factors. It could depend upon the size of the hotel. It could depend upon what is the revenue level. And more importantly, what are the fixed and variable expenses the hotel has, all of which we are going to see shortly. So the net income is good here, considering 25 cents is retained out of every dollar of revenue. But what does net income actually indicate? Net income depends upon 3 factors. Number 1, total revenue, which we saw earlier, operating expenses, which we shall see shortly, and non-operating expenses and fixed charges, also we shall see shortly. Now, it's important to understand that if total revenue increases, net income will also increase. And of course, if total revenue falls, the same situation. If all expenses are managed better, net income will increase. In short, you could say if total revenue goes up, net income will also go up. But if total revenue or all expenses decrease for any reason, net income will suffer. But let's understand operating expenses first. Operating expenses are of two kinds. One, direct operating expenses, number one, which is being pointed out right now. And number two, undistributed operating expenses, also being pointed out right now. Let's take a look at each one of these. Direct operating expenses are required to earn the total revenue of the hotel that we saw earlier. And notice that these expenses marked 1 belong to the rooms, food and beverage, and retail departments. In other words, these are the revenue producing departments of the hotel. Now, direct operating expenses could be payroll and related expenses or other direct expenses. Let's get to fixed charges now. What are fixed charges? Well, fixed charges are of three main types. One, rent. Rent is what you pay for any equipment or asset that you have taken on rent. Number two, property taxes. Property taxes are, of course, real estate taxes on the value of the hotel property. And number three, and very importantly, insurance. That is insurance of every asset, property, building, plant and machinery, equipment that the hotel owns. Fixed charges are required to earn the total revenue. These expenses generally don't move around a lot. That is why they are called fixed charges. Now, notice that the fixed charges, the three items we saw, rent, property taxes, and insurance, they do not affect the gross operating profit, which is above it, but they reduce net income, which is below it. Notice three other items before we arrive at net income. Number one, depreciation, and we'll talk about it very shortly. Number two, interest. Number three, income taxes. Depreciation is simply the use of the assets, the wear and tear that comes from using an asset. Interest, of course, is expense which is payable on a term loan taken by a hotel. And number three, income taxes are payable on, as you can see, the income before income taxes. Now, what are some ill effects of a net income decreasing over time, which we talked about earlier, right? Here, net income is shown as 411,773. Now, net income we also saw is the ratio of choice of owners. Why? Because it's purely bottom line. And what is bottom line? Well, bottom line is something that is arrived at after all expenses, financing costs, taxes, non-cash expenses are deducted. That is why it is called bottom line. It is at the bottom of the profit and loss statement. In fact, the last item, which is after deducting all these expenses. Now, if net income decreases, what happens? Return on investment for the owners suffers. That is why it is the ratio of choice for owners. So your focus as a hotel manager should be on increasing total revenue on the one hand and controlling all expenses on the other. A future video will tackle return on investment for owners. Now, what should be your goal? Well, increase total revenue and manage expenses. Manage means decrease expenses to the extent possible so that profitability or net income is boosted. Now, there are three features of net income. One, it is boosted by higher total revenue, which we saw earlier. It is boosted by lower operating, non-operating expenses and fixed charges. Well, best is that it is boosted by a combination of both 1 and 2, which is normally the case for every hotel almost. So net income, you could say, is a function of revenue on the one hand and operating and non-operating expenses and fixed charges on the other. Let's now recap our understanding of net income. Always compare net income between years. It is being pointed out right now. You could compare years 19 to 18, 20 to 19, and so on. And ensure that net income is not less than the previous year. Owners are very particular that net income keeps growing every year. Similarly, revenue is also required to grow every year and is being pointed out right now. Revenue is the fuel that ultimately will result in profitability. So it has to grow. And of course, ensure that your operating, non-operating expenses and fixed charges are not also going up in this case and are being controlled better. So at the end of the day, what are the three takeaways of net income? Number one is, of course, the formula itself. You take total revenue and deduct all expenses, operating, non-operating, fixed charges. Then you understand the influence that revenue has on one hand and operating, non-operating expense and fixed charges have on the other. And then, of course, the goal is always to ensure revenue keeps growing and expenses are controlled or decreases over time. Now, you have learned what net income can do, but more importantly, would you not want to know how you arrive at net income? And that is by calculating gross operating profit, which is a related KPI. Would you not want to know? Well, take a look at this video right